Okay. Okay, guys, let's. This is our session. This is our third session on the topic of exchange traded markets versus OTC markets. All right, our third session. Okay, so let's quickly go over. We've covered most of the. We've already covered all the topics, all the points. Let's quickly do a recap. Okay, this is your summary spreadsheet. So the way you should be studying, not just for this topic, but for every other. Shut down the PC here, guys. Shut it down. No PC should be, no desktop should be on. So I'll shut down your desktop. Okay? Alright. So the right way to study for this topic and every other topic for you is, you should, if you really want to internalize these concepts for a lifetime, you should open up this on a laptop, open this up, take your own notes, okay? And maybe listen to the, look at the replay, the class video, and then write down your own notes and your own observations. Once you do that, you will totally you will never forget this in your life again. Okay? Make sure you study like that. Make your own notes out of the class notes. Does that make sense? Okay? Alright. So let's quickly go through point number one. Anybody has any doubts? You have high transparency because in the case of OTC markets, you don't know what's happening. People are just getting together from, they're connected through networks. You could have people in different centers in the world. You don't know what their terms of contract are between each party, whereas on an exchange, because everything is centralized through a centralized server and the exchange is disseminating the data. Okay, if you want to see how exchanges treat the data that is generated on their website as their own property. Okay, so if you look at the IB website, you will find that they have, if you check the trading fees or the data fees, there's a place where you can check the data fees, right? So you'll see that there are certain fees. We as an educational institution, we get the data for free, okay, because they're supporting us as an educational institution. But if you're a professional trader or non-professional trader, you will have to pay some fees to get the market data, but the point is you can get it. It's not very expensive, you can get it. So there is high transparency, okay, so all this stuff. So here obviously, because I've highlighted these 2 points, point number 4 and point number 5, these are the 2 most important points of distinction. Okay.
Transparency is only with the price factor only, like price will be high or low. Transparency is only related with the price only. Other factor.
Yeah, well, actually there's other factor. That's why if you notice what are the words that I've used, I've not used the word price. I've said price, etc. What I've said is market information. So there's other types of information, price related. That is volume, open interest. Okay. Any kind of, because these are all usually listed securities, so any type of material event in the company, you have to disclose that. Those are all the listing requirements, right? So that's what is meant by transparency. All kinds of information, but mainly we were focusing here on price and other market related information. All right. Okay. So these are all the points of difference. Obviously 4 and 5 are the most important points of difference. Now the thing to understand is, so everyone clear about this? Yes. Any questions? Okay. All right. So this is your. These are your notes on this topic. All right. But what is happening is basically this. So I've highlighted this, okay, that 4 and 5 are the most important points. I've highlighted this in your note as well, okay. Okay, what is the point that we're going to discuss now? So what we have seen so far, okay, what we have seen so far as summarized on this spreadsheet, these are the traditional distinctions between OTC markets and exchange traded markets, all right. But what is happening is, due to the progress of technology, due to certain events that happened in the markets like the 2007 financial crisis and the regulatory response that followed, okay? Because of these factors, what is happening is that this is the second part of your learning on this module, is that what is happening is that the distinctions are slowly getting blurred. The distinctions between these two sort of types of institutional structures, the market structures, is slowly getting blurred. Okay, so what is happening is, okay, so one point that is normally, is the door fully closed? The noise. Okay, the first point that is getting blurred is that this business of usually being located in the same place, that is also, that requirement is going away. Okay, so in the old days, when let's say the New York Stock Exchange, which was started under a tree, if you were in San Francisco, you could not have traded on the New York Stock Exchange because you had to be actually physically under that tree in New York, right? So that was, those were the old days. But now what's happened is, because of the progress of technology, now everything is, even all the exchanges have their own software, and they have, so you can see that what you're connecting through on the Interactive Brokers, through their application, through their software, you're connecting to the NSE exchange software, and that's how you were able to trade on the NSE without being in Bombay, right? So that's the same thing. Now you can actually sit in San Francisco and trade on the New York Stock Exchange because it can be connected through electronic networks. You have a server for the exchange, and you can connect through your brokers software, okay? And you have this client server architecture. So this business that you had to be located on the exchange floor to trade on the exchange, that business is slowly getting, sort of that distinction is getting blurred, okay? That's getting obliterated. And there are certain exchanges like the NASDAQ. So if you go to New York, if you go to the NASDAQ market site, okay, you might have seen those big boards with the flashing tickers and all that. So the NASDAQ never had an exchange floor. Like I showed you a picture of the CME exchange floor. The NASDAQ never had an exchange floor. It was always just a bank of computers. Okay, so the NASDAQ actually, if you see the NASDAQ market site, it's just a bank of computers. Okay, so that's basically what it is. So this is getting blurred a little bit. A little bit of transparency is also coming into OTC markets, especially the more liquid markets like foreign exchange, okay, where you can use the Swander software that we are going to get into. And even on the NetGania, you can get foreign exchange rates, which are reasonably accurate, okay? They show you roughly where the market is. So now, so these distinctions are slowly getting blurred. Another point that was happening, another distinction that was the important distinction, what are these two important distinctions? What was happening is, even this actually started to get a little bit, these distinctions also started to get blurred a little bit because a lot of over-the-counter, a lot of OTC market players were very concerned about credit risk. You understand that credit risk is there in OTC markets. If I deal with anybody, I am exposed to that person's credit risk. Is that point clear? Yes. Because in OTC markets, you have no clearing house to stand as an intermediary, right? You're dealing, whoever you're dealing with, you're exposed to that person's credit risk. So if Lehman Brothers goes bankrupt, and let's say Barclays London has a lot of contracts outstanding with Lehman Brothers, it will be the same case as happened in this Mullah Dawood versus Akash Jamal. Okay, you had a contract with somebody, and you feel that the contract, you obviously expect the contract to be honored, but suddenly on that day on the day of the settlement, you find that the party has gone bankrupt, or whatever, for whatever reason, that party is not honoring the contract. So the position that you thought you had already squared, right? You thought that you had already sold the shares to this party and gotten rid of your position. But now suddenly, because the party defaults, you find that you are left with a position. You actually did not, so you're back with a position. Are you following what I'm saying? Okay, so that's why, so a lot of people were concerned with counterparty credit risk, okay? So in the OTC market, so some of the exchanges, what they started doing is, they took the exchange clearing house, okay, which has a very high credit rating. Normally exchange clearing houses, no exchange clearing house has, in the US certainly I know, but even outside I think no exchange clearing house has ever gone bankrupt. Okay, so they're normally well capitalized, plus they take money from the clearing members. Remember the structure we looked at? That every clearing member has to submit, has to put up a deposit with the ECH, right? So otherwise they will not be given the status of clearing members. So the ECHs are quite well capitalized. So exchange clearing houses have not gone bankrupt. So what they started to do is capitalizing on the fact that a lot of people in OTC markets were scared about the credit risk. Okay, so they're capitalizing on the fact that exchange clearing houses are very well capitalized and they have a good credit standing. So they started to say to the OTC guys that okay, you can do a transaction in the OTC market, but then you can actually pass it to us and we will run it through our clearinghouse mechanism, which is basically, remember the daily mark to market. Okay, so the moment you go into a clearinghouse structure, you will be subjected to daily mark to market and daily realization of profits and losses. Remember that structure? That's very important to understand. Okay, so so this is basically what happened, and so that's why you ended up with systems like that point that Kanuj was asking yesterday about CME Clearport. Okay, so I think that there's a link in your notes. Okay, so essentially what was happening is, this is what I was talking about so far, that there was a trend among markets, OTC players, to try to reduce credit risk. Okay, so this is what Clearport is all about. I'll just show you the diagram. I'll just click on this and show you the diagram. So now we are discussing this point, the important point of credit risk intermediation by the exchange clearinghouse, which is normally a feature of exchange traded markets only. Okay, but then it started to also be applied to certain OTC transactions. Okay, so this is the initiative by the CME Group, which is the largest. I want to just look for to change the format a little bit. I think we'll get this picture in the brochure. So the idea in Clearport is what I just explained. Okay, let's try and look at this. The idea is that you see what the genesis of the idea is, that OTC market players are a little bit scared about what is going to happen to their transaction. Okay, about the credit risk on their transaction. Okay.
So when you speak from there, the noise in the audio comes from a large distance.
Yeah, but I think yesterday we saw that some of it got picked up, right? There's you're afraid that it won't pick up.
Yes, no, it is coming from very gap line.
No, so you're afraid it won't pick up the noise.
Yes, sir.
But what did we see yesterday?
It was picking up.
It was picking up,
Very
right?
slow, sir.
Very low.
Yeah.
Okay. So then what I'll do is, then I'll try to stay at the back. Okay. So you guys just somehow put up with it. Okay. So all right. So okay. So this is a scheme in Clearport. Okay. So try to understand. So this is actually advanced knowledge on this topic of exchange traded markets versus OTC markets. This part that we are studying now, this is actually advanced knowledge, but you should be aware of it because these are current market developments. Okay. So what is happening in OTC markets is, in the case of Clearport, okay, what is happening is, you see that part with the yellow part or the orange background, that's the OTC market. The part in the orange background is the OTC market. So you have two OTC customers who are dealing with each other, okay, and the IDB is the interdealer broker, okay, the IDB is just a broker, you can think of him as a broker, okay. So you have two OTC customers who do transaction. In the OTC markets, they are connected by a broker, but that need not be the case. You can actually flip out the broker from the middle because two OTC customers can directly call each other. Okay. So now what happens is they do the transaction, then they pass it to CME Clearport, which means they connect to one of the clearing members. Okay. And once again, you can see the connection between. You can see how the setup is that the clearinghouse deals only with clearing members. You can see that setup, right? So what they do is they do the transaction in the OTC markets, and then they pass the transaction to CME Clearport, which means they have to connect to one of the clearing members in CME, and then it starts going through the normal clearing process. Okay, which means every day they will have to be daily mark to market, etc. Okay, so this is the first thing that is happening. So this had already started happening before the 2007 crisis. Because mainly it was driven by the fears that OTC market players had about credit risk and the fact that exchange clearing houses are very well capitalized, so everyone is comfortable with passing the transaction to them. Okay, so this is the first point. All right, so that, yeah. What is the role of CME clearing? No, ECN is the electronic communication network. Okay, so that is just a channel for our purposes. You can actually just forget about that IDB ECN part. Okay, that's just a middleman that need not always be there in every transaction. Okay, it's like Deutsche Bank London might be calling, say, Bank of Tokyo in Tokyo for a transaction, but they may actually be connected by a broker. Let's say like Tullett Prebon. Tullett Prebon is a money market and FX broker. Clearing member will have to be any clearing member who is affiliated to the CME clearing house. So you can't take, obviously you can't take a clearing member from the NSE clearing house. It has to be some clearing member who is a part of the CME clearing house. No, that's what I'm saying. Now we are not discussing the differences between OTC and ETM. We are now discussing how the two are getting, the distinctions are getting blurred. Because here what's happening, so the basic idea behind, so this is the CME Clearport setup, okay? So this is the Clearport setup, which means what is happening is people are doing a transaction in the OTC markets, okay? And then they are passing the transaction to CME clearing. For CME clearing to keep clearing the transaction on a daily basis, to do the credit risk intermediation. Okay, so you do an off-exchange transaction in the OTC markets, but let's say they do a 6-month deal. Let's say Deutsche London is doing a 6-month forward deal with, I'm just giving an example, okay? Now this particular transaction may not be cleared in fact by Clearport, but let's say they do a 6-month forward transaction with Bank of Tokyo and Tokyo, alright? So now each party is exposed to the other party's credit risk for 6 months. Okay, now they don't want to do that. So what they do is after doing the transaction, what might happen is, as I gave you the example, so focus on the yellow part first, the yellow or the orange part. See what it says in the chart? It says OTC, I don't know if you guys can read it at the back.
Yes.
And you see the lower part, it says OTC domain, right? So that yellow part is happening in the OTC markets. Alright, and then IDB is, as I said, interdealer broker. Alright, ECN is electronic communication network. So you can actually take that out also if you want, if that's just a middleman, okay? But if you take an example, say Deutsche London is dealing with Bank of Tokyo, and the broker is Tullett Prebon Tokyo. Okay, so Tullett Prebon Tokyo is just a broker, just like your Sher Khan or somebody else is a broker, okay? So the broker basically gets the two parties together, alright? And they do a 6-month forward FX transaction. So now what happens is neither of the parties wants to take the other party's counterparty credit risk for 6 months. Okay, they want to have a more secure transaction. Alright? So what they do is after this they pass the transaction to CME Clearport. Okay? So they have to be connected they have to sign up for Clearport. Okay? So then Clearport is this arrangement, this new arrangement. Passing the transaction means they pass the details of the transaction to CME Clearport. No, they don't cover the transaction. The transaction remains open. But let's say they report it. Okay, they report the transaction. You report the transaction to CME Clearport. Okay, which means now this is going to be treated as part of it's going to be treated like an exchange traded transaction. Now it's going to be treated as an exchange. Sorry? Now it will be covered because it has been passed to CME Clearport. Are you following? Is this clear? So the transaction is done. So remember what we are discussing now is
the counterparties in the OTC market can deal directly with each other.
Yeah.
Why are you connecting them with the clearing member? The deal is already.
No, so the deal is done. Now you have to be connected to a clearing member because now having done the transaction, okay, the transaction is not done on the exchange, it's done on the OTC markets. But having done the transaction, now you want it to be treated as an exchange traded transaction. Yeah, you can put it that way if you want, but it was done as an OTC transaction, but they want it to be cleared like an exchange traded transaction. So they pass it, so obviously you can't do that unless you affiliate yourself with the clearing member of the exchange. Because the clearing house, remember the clearing house does not deal with anybody who is not a clearing member. Okay? So if you want the clearing house to clear your transaction, okay, you have to connect to a clearing member. You have to have an account with a clearing member, and then the same rules apply. What we discussed in in the exchange traded markets. The same rules will apply. The moment you pass the transaction to Clearport, and now it's going to be treated like an exchange traded transaction. Okay, it's going through the clearing house. That's why you need the clearing member connection. Is this clear? Okay. Credit risk is not triggered.
No, I mean it is the company
Then they will have recourse to the clearing house. That's why. So if you have taken this transaction, if you have taken an example that say Deutsche London is trading with Bank of Tokyo, and they've done the OTC transaction and they've passed it to CME Clearport. Now if let's say Deutsche London defaults, okay, after 2 months, then Bank of Tokyo will have recourse to the CME clearing house. Because they've already passed the transaction to Clearport. No, who is not associated with the clearing member? Yeah. Then you have to just deal with the loss on your own. Just like many banks had these losses with Lehman Brothers.
Yes.
Many banks which had contracts outstanding with Lehman Brothers, those were all OTC contracts. Okay? So remember what I told you, that debt markets worldwide, generally debt markets are OTC markets. Okay, so when you understand the difference between debt and equity, one of the other ways of the institutional trading structure is that most equity markets worldwide are exchange traded markets, whereas most debt markets worldwide are, majority of it is OTC, especially the cash market. Obviously you have futures on interest rate products. Those are, I mean, the moment it's a futures contract, you know automatically it has to be exchange traded. You have futures contracts on debt instruments, but the underlying debt instruments, when you trade in the underlying debt instruments like corporate bonds, government bonds, those are all OTC markets worldwide. Alright? So therefore what happens is this clear now? Mansi, your question is answered? Alright, yeah.
Like by introducing the clearing member in this OTC market, we are trying to reduce the counterparty risk.
Yes, that is the whole
That
idea.
is the whole idea of this.
That is the whole idea. Okay. So this whole thing. So this is advanced topics that this is an advanced topic that you're learning. Having seen the traditional distinctions between OTC markets and exchange traded markets, now you're trying to find out how these distinctions are actually over time. They've been slowly they've been getting blurred a little bit. Okay. The distinctions are no longer that clear. And one of the ways this is happening is this on the aspect of the two important points of distinction, which is customization of contracts and credit risk intermediation. Okay, so on this point of credit risk intermediation, you had already before the financial crisis, you had structures like products like CME Clearport, which is basically what's happening here. There are two forces. The exchange clearinghouse has a very high credit rating. Okay, so they're exploiting that. And many OTC players are afraid of credit risk. They're scared about the credit risk that they have. So they want to quickly pass their transactions from the OTC markets to the CME clearinghouse, okay, so that they can reduce the credit risk exposure on their contracts. Is this clear? These are the two forces driving this phenomenon. So this is something to be aware of, that CME Clearport is an example of how the distinctions between OTC markets and exchange traded markets have been slowly getting blurred, okay? Is this clear to everybody now? This structure? Okay. So now understand one more thing here. Let's see what is in the notes.
Since the difference is getting blurred, people will shift more towards ATM or OTC.
Well, no, actually, you are just coming to that. This is the same question that you asked yesterday. Is that why would anybody even bother to trade if there's so much such a lot of high levels of credit risk in the OTC markets? Why would people even bother to trade in OTC markets? And the answer is, so it's a good question. That's a good question, and the answer lies in
The customization.
point number 5.
Customization.
Customization. So the ability to customize contract terms is very highly valued by participants, market participants. Okay. So there's let's say a corporation needs to buy only 543 barrels of oil, but if you go to the NYMEX contract or the Brent crude oil contract, the contract size is 1,000 barrels. You can't trade in 543 barrels. Okay, so customization is a very important aspect of OTC market, the ability to customize contract terms. So you'll see the nice interplay between these two. Okay, so what is happening there's basically this. Let's just try to follow the notes, the sequence in the notes. All right. So the point I'm trying to make here is that there is so having studied the traditional distinctions, we have to be also aware that there is a progressive blurring of the distinction. Okay. And one example of that is CME Clearport, okay, which was, you can read the link and you can get an idea of what was going on, okay. So this was going on even before the so-called GFC. GFC stands for Global Financial Crisis, okay, which is the 2007. It really started in 2007, but the Lehman bankruptcy was in September 2008, okay. So you can call it the 7-8 crisis. So the GFC, okay. Now, one of the things that has happened is, the other thing that is driving this blurring of the distinctions is what we can call the regulatory response to the GFC. Okay, so in the GFC, what happened is a lot of these, obviously, as you know, Lehman Brothers went bankrupt, so that caused a lot of fear and panic in the markets, mainly because The fear mainly was driven by the fact that people were not aware of the levels of counterparty credit risk exposure. Okay? Because Lehman had thousands of OTC market contracts outstanding with various other banks. Goldman Sachs, Morgan Stanley, Barclays, okay, Deutsche Bank, various banks. So all these banks, since they were all part of the interbank OTC market, right, they had all had thousands of transactions with each other. And so there are many banks which had many contracts outstanding with Lehman Brothers. And so the problem that people felt, people were really scared of, is that nobody knew who had how much exposure to Lehman Brothers. So if I'm Deutsche London and I'm dealing with Citibank, I'm not maybe directly worried about Citibank as such, but I don't know how much exposure Citibank has to Lehman Brothers. So I might worry that actually Citibank on its own was okay, but because of its exposure to Lehman Brothers, it might actually also go bankrupt. It may not be able to pay because it has a lot of money due from Lehman Brothers, which is not going to come through. So because they don't get their money from Lehman Brothers, then they can't pay the other counterparties. Okay, are you getting the picture here?
Yes, sir.
All right. So this was a fear that people had in the market. Okay. So this is basically because there was not. Remember that OTC markets are not that transparent. So I already told you that when the deals are all done on a bilateral basis. So then I don't know if I'm Deutsche London, I don't know how many deals Citibank has with Lehman Brothers. Okay, because I'm not privy to those transactions. So therefore, what happens? This is what causes the problem, because of lack of transparency. There was a lot of fear and panic in the market because people always assume the worst. When there's a crisis and you don't know what the situation, you always assume the worst. So that's why the market kind of froze up. All right, and that's where the central banks came in with a lot of accommodation. They cut interest rates, they pumped in money, right? Increased the money supply drastically. They started buying bonds, etc. So all kinds of stuff that the central banks did. And essentially, so one of the things that happened initially when the initial panic settled down, okay, then one of the things that the regulators did was they insisted on this new entity, which is the CCP, okay? Okay, so CCP, essentially what is happening is that, remember, if we go back to okay, so let's just briefly look at the exchange traded market setup. So just recapping the setup in exchange traded markets. Okay, the reason that credit risk is minimized is because every transaction goes through the ECH. Alright, the ECH is the counterparty to every transaction, and they are taking margins, they're taking initial margins, and every day's profits and losses, they make sure that they collect from the people who win and lose. So they pay it to the people who win and they take it from the people who lose. Remember all this?
Yes, sir.
What happened? Half the class seems to be asleep. Okay, the responses, okay. Responses should be a little bit more energetic. Because it's not even lunch, right? Okay, so this is the exchange traded setup. So it's essentially what you have in an exchange traded market is you have centralized clearing. Clearing, you understand, clearing is just the settlement of the trade, making sure that the money is paid, making sure that securities are delivered. Okay, you don't have those Jamal versus Dawood kind of situations where one guy pays the money but one guy delivers the shares but the other guy doesn't pay the money. Okay, so this is clearing. Clearing, this is what it means. Making sure that the trade is settling properly. Remember transaction date and settlement date? So on the settlement date, the assets have to be exchanged. So the clearing firm, essentially, the clearing house ensures that the exchange of assets goes through smoothly. Whoever's supposed to deliver, whatever they're supposed to deliver, they should do it. Okay? So centralized clearing in an exchange traded market. You have centralized clearing. That's why you have a lot of transparency. Because if the exchange clearing house knows every transaction, remember what we discussed in the OTC markets. Nobody knew, like Deutsche London does not know how many transactions Citibank has with Lehman Brothers. Okay, because it's an OTC market, it's opaque. Okay, every transaction is bilateral. Nobody knows what the other guy has. Whereas here, this is not bilateral, everything is going through centralized clearing. So the ECH, if you go into the ECH, you can see every transaction that has taken place. Because in every transaction, they are a counterparty. Right? So what you have in exchange traded markets is centralized clearing that gives you a lot of information about the market exposures, etc. Right? So essentially what the regulators said is, because in the OTC, in the GFC, they had to come up with so many interventions and they had to pump in money supply, they had to cut interest rates, they had to support, basically the government had to bail out a lot of firms. Okay, the German government had to bail out a lot of banks, so did the British government, the US government bailed out a lot of banks, alright? So because of all these emergency measures that they had to take, the regulators said that now we are going to do something about it to ensure that it doesn't happen again. So one of the things they said is that OTC markets are very opaque, alright? We don't like the fact that we don't know how many transactions are outstanding, and because the credit risk is not being managed on a dynamic basis, on a dynamic daily basis. So end up suddenly what happens after 6 months, you realize that you have like a $500 million exposure on Lehman Brothers, and then suddenly they go bankrupt. Okay? This $500 million exposure would not have happened if you had been settling your profits and losses daily. Because how much can you lose in a day? If you lost 500 million over 6 months, obviously in a day you would have not lost that much. So if you had been settling your profits and losses every day, you would not be left with these huge exposures suddenly at the end of the contract. And many of the contracts are very long, 20 or 30-year contracts, right? Are you following what is being said? Yes. Many parts of the class in front are quite disconnected. Is it very, very uncomfortable for you guys? Yes, to have, then you can turn towards this side if you want. The chairs swivel, right? Okay? So try to pay attention, because as I think Tanuj has raised an important point. If the voice doesn't get captured properly, then it won't be we won't be able to capture the full. Are you guys okay with that? Okay. All right. Okay. So this is what the regulator said, that we don't want to be in a position like this once again where we have to come and bail out so many companies. Okay. So what they want to do is they said no more of this opacity, no more of this bilateral clearing of contracts. We want to have an exchange traded market type of situation, and we want to impose it on the OTC markets. Okay, so then what they said is that we want to introduce this concept of all this stuff is in your file. You have the access to this file. Alright, so what they're saying, this sheet is called OTC Markets plus Central Counterparty, CCP. Okay, so I've just called it clearing house. Maybe I just didn't rewrite the name. So CCP means that is to be read as Central Counterparty, which is obviously also functioning as a clearing house. Okay, so the label is not incorrect, but it could be more illuminating. So now what is happening is, I have to eliminate those. Okay, we can keep those clearing members. So again, in the central counter, now the CCP is what? The CCP is like a exchange clearing house. I should not use the word exchange because now we are talking about OTC markets. But it's like you take an exchange clearing house kind of structure and you put it in the OTC market setup. Are you following what is happening? So all these CM1, 2, 3, 4, 5, 8, etc. These are all OTC market players. Okay? So this is basically what the regulator is now saying, is that these are all these guys playing in the OTC markets. But we want you to, maybe I should put a label here as this is the OTC market. Just hold this. No, just hold this. So I should put a label here. Alright, so this is what this situation is, okay? This is now OTC market, so you're taking the exchange clearing house kind of structure and you're imposing it on the OTC markets, alright? So what the regulator is saying is, even in OTC markets, if we have fairly standardized transactions, because many OTC market transactions are fairly standardized, even though there is a possibility of customization, many are quite highly standardized. So in those cases, the regulator is now saying that we want those transactions to be cleared through a CCP. Okay, so this CCP will be imposed in the middle of the OTC market, and all of you guys who are trading in all these kind of transactions like interest rate swaps, plain vanilla interest rate, standardized interest rate swaps, okay, I want you to make sure that you trade through a clearing house. All these transactions have to go through a clearing house. Okay, so this is a new regulatory requirement. Okay, so therefore what is happening is, because so now all of these guys are, so therefore whenever you have a clearing house, you will have a concept of clearing member. Okay, because these guys will have to deposit big chunks of money to be a part of the clearing house. So the CCP is also another clearing house. So these guys will have to sign up as clearing members, and then whenever you want to do a deal in the OTC markets, you have to be connected to one of the clearing members, and then that deal will have to go through the clearing house. Okay, so therefore again this will have the same structure as you have in the ET, in the exchange traded markets. There will be daily mark to market and settlement of profits and losses, like you have on exchange. Okay, so is this point clear now? What is being done? Everyone clear about this? So the concept of central counterparty came up after the GFC, after the regulators had been had spent time scrambling to save the system, all right, and pump in so much money, bail out the banks. Then they said, okay, what can we do to make sure that it doesn't happen again? And one of the ideas was the CCP. So now OTC market transactions, standardized OTC market transactions have to go through a CCP. Okay. So now where you see that this is another point. So even on the point, so first we saw that this is basically what is happening. So first was the idea of CME Clearport, which existed even before the GFC. And after the GFC, this trend has been further sort of accelerated, because now regulators are pushing you forcefully into a CCP structure. Okay, so now what we used to say, right, in this chart we are saying that this what we used to say on point number 4, that in OTC markets that counterparty credit risk is managed directly by counterparties. This, strictly speaking, is no longer 100% true for those transactions which are required by regulators to go through a CCP. Okay, are you following what I'm saying here?
Yes, sir.
So it's like I'm actually contradicting myself, because first I gave you a whole bunch of distinctions, and then I'm saying that the distinctions are getting blurred. But you have to understand how it's happening. These are the traditional distinctions which you have to be aware of to understand the theoretical differences between the two types of institutional structures of markets. But then you have to also see that because of events, because of a regulatory response, because of technology, okay, things keep morphing, things keep changing. Okay, so that is what is happening. So one thing that is happening is point number 4, distinction is getting blurred because of partly voluntary actions by market players in OTC markets who are afraid of credit risk, moving to arrangements like Clearport. That's one. Second is regulatory response to the GFC, where regulators are now insisting that transactions, standardized OTC transactions, must go through a CCP. Is everyone clear? Has everyone understood the CCP structure?
Yes, sir.
Okay. Yeah, so the regulator is basically, the regulatory mechanism and is functioning in 2 ways. There is a multilateral setup like a BIS and Bank for International Settlements, but mainly the regulation is done on a jurisdiction basis. So in the US you have the CFTC, okay, and the SEC, that is Commodity Futures Trading Commission. Here you will have most of the regulation here is being concentrated in SEBI and RBI. Okay, so all your forward markets commission in India has been merged into SEBI. So SEBI is now becoming the central regulator almost for everything, and then RBI takes care of the balance, right? So this is what is happening. Okay, so this is the trend. This is point number 4. The distinction is getting blurred, but basically what is mentioned in your notes here, if you see.
Central counterparty.
So this ECH should have an account in RBI or in any bank?
No, the ECH you're talking about, are you talking about an exchange traded structure?
Yes, sir.
So in an exchange traded setup, the ECH, they would not have they can't have an account with RBI if you're talking about an Indian context, because they can't have an RBI. Even in the US, the ECH cannot have an account with the Federal Reserve,
Yes, sir.
because that's only for banks. Okay? So ECH will have accounts with banks. They will have accounts with banks, but they will have capital. They will hold some of their capital in the form of treasuries,
So because
sovereign debt.
then they will have some risk, because the bank can also.
Yeah, so they have to. That's a good point. There is a circular thing,
Yes,
right?
sir.
But they will be capitalized in other ways. They will have some of their capital in the form of sovereign debt. Okay, so those kinds of things. So that they will have some kind of protection from those kinds of.
Then do anyone regulate the ECH also?
So ECH also is regulated by the terms and conditions of the ECH, just like in India when you see exchange clearing houses, okay? They are required to follow the guidelines of SEBI. So SEBI says that it must have so much capital. So even in the US, they will have CCH, CCP, there will be guidelines that this must have so much capital, etc., etc. So the regulators set the terms of the CCP. Okay? Okay. Yes. No, CCP, I'm not sure exactly whether the CCP has been implemented in India. They have discussed it. I'm not sure, I don't know the latest news whether it's been implemented in India. But what you need to learn is just the idea of the CCP and how it came about. Yeah, so this is US, European markets, but it can come in India as well. In fact, I expect that it will come because in India the regulators are very afraid of OTC markets. They've not allowed OTC markets to develop because they feel that they're not transparent. So, if anything, I would expect CCP concepts to take hold in India much faster. Okay, but we have generally neglected our OTC markets. That's why our bond markets are not developed, etc. Okay, so is everyone clear about this so far? Okay, now we're talking about a third factor. Okay, first we said okay traditional restrictions, then we said restrictions are getting blurred, and then on point number 4 we looked at how credit risk intermediation by a central clearing house can happen even in OTC market. Okay, there's too much noise going on, guys. Now if I see anybody talking, I'll just have to deduct marks. There's too much background noise happening. Okay, so now there's another point that you have to be aware of to really understand the difference between the two types of markets. You see the part that I've highlighted here. If I just make that, if I make that in, put that in bold lettering, okay. So if we go back to the table, what is point number 5?
Standardize and customize.
Yeah, so the point number 5 is standardization versus customization, okay. So the point is that look at this. What am I saying here, okay? That while there is a blurring of the distinctions, okay, the point I'm trying to make here is that there is a limit to which the distinction can be blurred. And what is defining that limit? Okay, the limit that is, the factor that is defining the limit is this business of customization versus standardization. So if you know that, as I already discussed in response to Tanuja's question, that the reason people go for OTC markets is that gives you, these markets give you tremendous flexibility in terms of in setting the contract terms. So you can customize the contract terms. So in the OTC markets, you see all kinds of very exotic structures. Okay, some of those things you can see in the book that I've given you, that risk management solution booklet from Standard Chartered. Okay, if you want to get an overview of various complex structures, some of those structures are listed in those in that book. Okay, so you can see, you can have very, and those are not, that's not an exhaustive list. So you can have very exotic transactions in OTC markets because it's driven by the customer needs, okay, and the ability of OTC market players to customize the contract to serve the customer. Okay, so therefore what happens is, now think about what is involved when you're doing a CCP structure. If you go, so the point I'm trying to make is that while the distinction is getting blurred in that the CCP structure is there in many OTC transactions, okay, in OTC markets, okay, it's coming into the OTC markets, and so therefore credit risk intermediation through a clearinghouse is happening even in OTC markets, alright? But the extent to which this distinction can be blurred is limited by the amount of customization that is there in OTC markets, okay, because OTC markets are noted for their customized contract terms. So the more customized the contract terms, the more difficult it will be to route it through a CCP. This is the point that I'm saying, that I'll explain why. Okay? Have you understood what I'm saying first? The point I'm saying is written there in the notes also. Okay? That basically, okay, you can listen, but maybe it's a little clearer with the way I'll explain it. So the point is, the extent to which this distinction on the point of credit risk intermediation is getting blurred is limited by the degree of customization that exists in OTC contracts. So the point is that the more customized the OTC contract, if you look at a bunch of contracts at any point of time, okay, and the more customized those contracts, okay, the more difficult it will be to put it through a CCP,
Yes, sir.
to route it through a CCP, okay. Why, I'll explain later, but first you understand what I'm saying, okay. First what I'm saying is that as you try to blur the distinctions and make OTC market transactions like ET market transactions, okay, by introducing a CCP, Well, theoretically you can do that, but at any point of time, we look at a bunch of OTC contracts, and the more highly customized those are, okay, the more difficult it will be to route it through the CCP. Okay, that's why the requirement is only the standardized contracts go through the CCP. Okay, now we'll understand why. This is assertion clear? You understand what I'm saying? That the more customized the OTC contracts, the harder it will be to route it through a CCP. Okay, why is that? Okay, now you read that here. Okay, so remember what a CCP does? The CCP is going to engage in daily mark-to-market and clearing. Okay, daily mark-to-market and settlement of profits and losses. That's the whole idea of a CCP. Okay, or any clearing house. Okay, now if the transaction is so customized, and such an exotic transaction, okay, then you are not likely to find a price for it so easily in the market. Because remember that daily settlement of profits and losses requires everybody to agree on what the price is. Right? Today if I say, okay, what is dollar yen closing in New York, that's very easy to find out, and nobody's going to argue about it because it's a well-known figure, everybody's trading in it. Okay? But if I have a highly customized instrument, then that's not being widely traded in the market. So therefore, I don't see a easily believable price. I don't see a credible price. Are you following what I'm saying here? In a highly customized transaction, that transaction, just because it is highly customized, it's not a standardized transaction. Okay, so it's a highly customized transaction, so you can't see that transaction being traded regularly in the market by everybody. Okay, let's look at some, for instance, look at some prices. If you look at some OTC market prices, if we just look at some prices, okay, see how deceptive the search is. I search for NetDhani and the first search is somebody else. I could have gone straight to Forex. Sorry?
So you have typed with NetDhani, then also the first search is...
Yeah, the first item is deceptive. Huh? I would have just blindly clicked on the first term. Okay, so you see this stuff now. This is spot foreign exchange. You can see your favorite asset, Bitcoin also. Alright? Okay, now why is this? Now these prices are fairly accurate. Okay? Why is this fairly accurate? Because these spot foreign exchange is standardized. You know the settlement date is 2 days from today. And the instrument is very simple. Okay? You just buy, instrument basically is price per unit. Okay? Price of €1 in US dollars. Okay? And it is actively traded. So it is not, it's a very standardized instrument, spot foreign exchange. Is everyone clear about this? That's why you can disseminate these prices, because everybody's trading them and everyone knows what the price is. Okay, even though it's an OTC market, but because it's such a big market and so many people are now interested in it, these prices get disseminated. Now, if there is some highly exotic option, let's say on dollar yen, okay, your spot dollar yen is very well known to everybody. It's actively traded, it's a standardized instrument. Okay, so there's no problem, everybody knows what the price is. Now if there's some highly exotic option on dollar yen, like you see in the book, you see a mention of barrier options, knock-in and knock-out options. Okay, so if you have exotic options, okay, exotic option structures on dollar yen, those contracts are so customized that very few people trade them. Okay, so if very few, why is this happening? Why are you able to see these prices? Because this market trades $5.1 trillion a day. There's $5.1 trillion of volume going through this market every day. So these standardized instruments are being traded actively. That's why you can see the prices. If I have are you able to follow this point? That if I have a highly exotic option on dollar yen, let's say maybe a 10-year option, highly customized in terms of how the option will behave, okay, what it will do for the customer, who has to pay what under what circumstances. If I have a highly sophisticated, very complex instrument, which is highly customized, then that's not something that everybody is trading, like foreign exchange, like spot foreign exchange. Is this point clear to everybody? No, spot foreign exchange, unlike, I used the wrong word, I should have said unlike. Okay? So unlike spot foreign exchange, which is very standardized, if I have a highly exotic option on dollar yen, maybe a 20-year option or a 10-year option, that's a very customized contract. And that is not something that is going to be regularly traded by everybody. So therefore, the price discovery, here there's price discovery happening. Remember the expression, price discovery? Remember, there's a market trading. The moment you exchange assets, you have to establish an exchange ratio. which is the price. Okay, so that's what is price discovery. Continuous interaction of demand and supply and setting of a price in the market. Okay, so here you can see price discovery happening regularly, okay, and an actively traded market. But in the case of exotic instruments, structured, highly structured and customized transactions, the price, it's not clear what the price actually is, what the market price is, because the market doesn't trade very often. Is this point clear? Now, obviously, if you want to settle things through a clearing house, you need to agree on the price. Remember we discussed yesterday about the oil price, okay? So we need to, everybody knows what the oil price is because the oil price is being traded on an exchange. Okay, if you look at crude oil futures, they are being traded on an exchange. Okay, so everybody knows what the price is, so no one argues about it. When, let's say if you go long crude oil at $70 and then the price closes that day at $65, okay, you know that you have a $5 loss and you don't waste your time going and arguing in the exchange that no, this is not the closing price, it's actually 67, okay? Because everyone knows what the price is, there's no dispute. The prices are transparent and everyone is agreeing about the price. That's why you can have daily mark to market, because people are not fighting about the price. Just imagine, if I'm losing money, okay, if I bought crude oil at $70 and now the exchange closing price is $65, I'm losing money, right? So I have an interest to raise the closing price. I would like the closing price to be maybe 68 or something. So if there is a situation where the prices are not clear to everybody, the prices are quite opaque, okay? It's a customized contract, it does not trade actively, so no one really knows what the price is, okay? So in that case, what's going to happen is people are going to start fighting. If you try to push that kind of transaction through a CCP, okay, people will start fighting because they will not agree on the closing price. The guy who's losing money, he will say, no, actually the price is higher. And the guy who's winning money on a short, who's making money on a short position, he will say, no, the price is lower. And because it's not a transparent price which is set on an exchange, like a crude oil West Texas Intermediate futures contract, okay, then there's obviously, you can't settle that argument because no one really knows what the price is. Are you following what I'm saying?
Yes, sir.
Chanda, are you following? Okay, so this is the idea basically. Here I'm trying to explain the idea that if you try to push OTC transactions through a CCP, okay, because the CCP has to do daily mark to market. And daily mark to market, this is not something that we discussed when we were discussing the mechanism of daily mark to market. But it's an underlying assumption, obviously it's an implicit assumption, that if people are not even agreeing on the price, if people don't agree on the closing price, how are you going to have a mark to market without fighting? Because then you will have people fighting with each other because this is not, I don't agree, this is not the price, alright? If this kind of situation comes up. So essentially what is happening is that while there is the distinction between this credit risk intermediation is being imposed on OTC markets also, okay, through the CCP, the extent to which you can do that is limited by the degree of customization in OTC contracts. Is at this point clear to everybody? It may sound a little bit complicated, but try to just read it again and understand the point, right? And this brings you back to the other point of distinction, which is touching on the question that Tanuj asked, is that if there's so much credit risk in OTC markets, why should people even bother? And the reason they bother is because of the customization. And that means a lot to market players, so that's why they trade in OTC markets. Is this point clear to everybody?
Yes, sir.
So it is basically one of the points of distinction is limiting the extent to which you can blur the distinction on the other point. Is here. So distinction on point number 5. The more customized the contracts in OTC markets, the less you can blur the distinction on point number 4. Is this point clear? To summarize quickly what I mentioned, what I discussed so far. The more the difference in the more customized the OTC contracts, and these are obviously always standardized, okay? And the more customized the OTC contracts, the more difficult it becomes to blur the distinction on point number 4. Is everyone clear about this?
Yes, sir.
Okay? Alright, so this is the point. So these are slightly advanced concepts, but I wanted to make sure that you're aware of these things. It will also help it will also check your understanding of the main distinctions, the traditional distinctions. Okay? Okay, so this is all explained in your notes. Alright, so there are some other risk mitigation tools which you should be aware of. I'll just mention it briefly so that you can refer to this discussion and just wrap it up. There's another concept of bilateral collateralization. Okay, bilateral collateralization only means that okay, so you have a traditional OTC market here, and all these are, I've used the expression clearing member, but it's not really required here. These are just basically market makers. Let's think of them as just market makers or speculators. They could all be market makers, speculators, dealing with each other in the OTC market. So you can just imagine, like, you draw arrows from each of these parties, draw arrows connecting two of them. Okay, so you just draw arrows connecting two of them. 5 can trade with 4, 7 can trade with 2, and all these things. These are connected to each other. Okay, so you have an OTC market. Now you have the meaning of bilateral collateralization is, let's say 5 is trading with 4. Okay, so CM5 is trading with CM4. It's an OTC market. Okay, so normally what happens is, if they do a 5-year transaction, what will happen is that 5-year transaction, the 5-year foreign exchange forward contract, that will mature at the end of 5 years. Okay, so there is the transaction date is T0. Okay, today, and the settlement date is T plus 5 years. Okay, so in that 5 years, obviously the price can move quite significantly. Okay, so therefore you could have at the end of 5 years, if one party defaults, the other party might have a large loss. Okay, so what they try to do is to try and mitigate this. What they do is, let's say maybe on a weekly basis or something, they will try to settle their profits and losses on a weekly basis or a daily basis, whatever they agree. Okay, so it's just an arrangement between 4 and 5. Okay, CM4 and 5, let's say, where they are basically agreeing to settle their losses and profits on any short-term period, on a rolling short-term period, on the basis of a rolling short-term period. So you could agree to a weekly settlement. Okay, so they agree between themselves that every week we will tally and see on our outstanding contracts who's making money, who's losing money. If I am losing $3 million and I'm supposed to pay you $3 million, I will pay you that right now at the end of 1 week. Sorry? It is basically, without CCP, that's why it's called bilateral collateralization. Remember what we are discussing now is, the term is bilateral. Okay? So it is bilateral collateralization. This is again trying to reduce the credit risk. Okay? If they have a long-term contract, they enter into a bilateral collateralization agreement. Okay? Where they say essentially, they actually may not pay the $3 million, but they will post the collateral. You understand what collateral is?
Yes.
Collateral is like security. Okay, so you're taking if you take a mortgage for your house, the house is the collateral. So the bank is lending you the money, and the security for the bank is the collateral, which is your house in a housing loan, right? So that's the collateral. Collateral is the security in a secured loan, in a secured lending transaction. So what they do is that they may not actually pay the money in cash, but what they might do is they might post $3 million worth of treasury bills. So if I owe you $3 million, at the end of 1 week, we take a snapshot, we see who owes money to who, and then I find that I owe you $3 million on the mark-to-market basis. And then what I do is I give you $3 million worth of treasury bills. Okay? And then again at the end of the next week, we will do the same exercise once again. This time maybe you owe me $5 million. So now you will give me $5 million of treasury bills. Okay? So that's why it's called collateral. So it's called bilateral collateralization, which is written in your notes. So that's all it means. So essentially the idea is always that the one way you reduce your credit risk is by periodically settling your profits and losses instead of holding on to the end of the contract. If you have like a 10-year contract, you don't wait for the end of 10 years and then see whether the other guy defaults or not. You settle your losses periodically. Okay, so that's basically the idea behind all kinds of credit risk mitigation measures. Okay, that is one. All right, what is the other point that is mentioned in your notes? Okay, the other is portfolio compression. Okay, so portfolio compression briefly is the idea is that if you let's say these OTC market counterparties, they have thousands of contracts outstanding between each other. Okay, any two counterparties could have thousands or even millions of contracts outstanding with each other. So what they might do from time to time is they might actually look at some contracts and they might see that there are certain offsets. Okay, that they have so many contracts outstanding that they could actually end up with the same exposure, but they could cut down the number of contracts. Okay, maybe that 10 years earlier I did a deal, which was maybe for 15 years. Okay, so now that deal has 5 years outstanding. Okay, 10 years ago I did a 15-year deal with you. So that deal now today has 5 years left. That's clear. If I did a deal in 2008, if I did a deal with another person, okay, which had a 15-year maturity, then today that deal has a 5-year maturity. Okay, then I might have done some other deal yesterday which also has a 5-year maturity. In the same counterparties, because there are so many transactions going on, you're covering customer transactions back to back. So if you go through and you do an inventory of all your trades and transactions, because these counterparties have so many transactions with each other, you might find that there is a way to cut down the total number of outstanding trades. Okay, by rewriting some trades, you can cut down the total number of outstanding trades. Okay, and then still reduce your exposure. Okay, because all these transactions are settled on a gross basis. Okay, you're not supposed to settle on a net basis. You have to settle each of these transactions on a gross basis. Okay, so that's another thing that people use. They try to cut down from time to time. They review their portfolio, and then they see if they can have the same exposure with a fewer number of contracts. Okay, so this is another idea. Yeah.
Why is it the main point to a regulator or a CCP to have such options so that we can settle the risk also, settle the we are acting as market?
Yeah. Yeah. Yeah, so her question is, why do you need a regulator if market participants are anyway taking proactive measures to reduce their credit risk? That's because the regulator wants to be doubly sure. He can't take a chance. It's like,
Counterparty wants surety.
Counterparty wants that. More importantly, the regulators do it because the regulators want to be sure about how safe the system is. Okay, it's like saying that, if I don't have CP, then those who are really interested, they will study anyway, even if there's no CP. But we put the condition because that's why we have exams. Technically, you don't even need to have exams because those who want to study will study anyway. But the reason we have exams is basically we can't rely on everyone to do that. So that's why the regulatory response is, regulatory presence is there because they want to make sure that everyone follows what they think people should be doing. Okay? If you don't have a regulator, then only those who are proactive will do it, but some other people may not do it. And they may actually land the system in trouble. They may cause trouble for the system. Okay? Yeah.
Commercial borrowing, so
Yeah.
sir, in that case, there are two counterparties, but the company transfer is funds to its subsidiaries in other countries.
Okay.
Right, so in that case, what is the role of this OTC? I mean, what will be the
I didn't understand your question. So your question is on external commercial borrowings. Okay. So external commercial borrowings, they may borrow, like say Tata Sons might borrow, or Tata Motors might borrow something in their name in India, and they might actually transfer it to Jaguar Land Rover in the UK. That's what you're saying. Yeah. They may borrow in sterling and then they may transfer the sterling to Jaguar Land Rover. That's an OTC market transaction. That's an interbank, there will be a syndicated loan or some such transaction or a bond issue. Okay? So they do, that's an OTC market transaction. And so that doesn't have any connection with ET markets. Sorry. That's a purely OTC market transaction. So they would borrow the money in their name, which means that Tata Motors India is liable. The legal liability is on Tata Motors India, the holding company. And the money actually might be given to Jaguar Land Rover in the UK. Yeah.
So in that case, the company may just file their mark-to-market on the end of the year.
Yeah, so these kind of transactions, if you're looking at a loan transaction, it's generally very difficult to have a mark-to-market situation here because this is a one-of-a-kind instrument. Okay, generally it is quite difficult. Okay, you can class it into the category of credit, but it's a one-of-a-kind instrument, so it's very difficult to have mark-to-market as such on this. Here, what happens is typically the banks, as be a syndicate of banks, okay, they will all team up together and then they'll lend, let's say, $300 million to. No, there's no CCP involved in this kind of transaction. What you're describing, you're describing a loan taken by, let's say, Tata Motors in India, let's say they borrow $300 million from a syndicate of international banks, and then they give that amount to their subsidiary in the UK to use, okay? But there is no CCP involved in this kind of transaction. It's a pure OTC market transaction between a consortium of banks and this borrowing client, which is Tata Motors. Okay, so here there is no CCP involved. Okay, the banks will have to monitor. They will analyze the credit risk of Tata Motors and decide whether they are good for, let's say this is a 10-year transaction. Are they good enough? Are they a good enough credit? Such that we can actually lend them $300 million for 10 years. That's what. There's no CCP in this. Is this clear? Okay, let's continue with. Okay. Now, ordinarily, what I would do at this stage is, okay, let me quickly run through what has to be done with the project. So now the email that you sent me, where's Ridhima? Okay, the email you sent me, that is the TWS login or the Oanda login? You said you had a problem. TWS. Okay. So Oanda login, let me show you some stuff. We'll keep on monitoring the TWS situation, and that's why I want to set up the backup software. So now at this stage, ordinarily what I'm going to do, so I'm going to deduct marks for Sonam and who is that next to her? Okay, Himani. I have to remember this. I'm sure I'll remember it. Okay. Is the CP sheet open? Yes. Because you two are constantly talking. See, this I have to wait. Sonam is Sinha's group. -2. Sorry. See. Okay, where is Himani? Same. Okay. All the groups are sitting together. That's the problem. All the buddies sit together and then they talk. Okay, see, at this stage, ordinarily I would go into a discussion of all the various types of financial intermediaries, financial market players that exist, okay, so that you can understand the landscape, okay, all these things like investment banks, market makers, all these kinds of, but at this point I don't have the time because I need to get you ready for the next project. Okay, so I'm going to set you up for the next project, and at this stage we are going to look at our backup software. We would still prefer to do this project on the TWS, but since I'm a little bit worried about what's going to happen, I'm going to now set up the backup software. I'm going to show you how to set up the backup software, right? So just hold this. Maybe you can just come here and hold it close so that the noise hold like you're taking an interview, right? Just. Okay, one sec. What do I have to do?
Can you put that picture of CEME portal on the notes?
Which one?
Put the picture of CEME.
CME is already there in the notes. The clear port.
Yes.
Okay. You're talking about the picture. Okay, that's a good point. Yeah, this port picture. Okay. Let me put that. So let me put that as a separate. Good point. I'm just going to put it here so that you know that. All right. Okay. So let's look at. Okay, what you have to do is, let's look at. Okay, demo. I'm going to put this in your. At this stage, I'm just going to put it here. Okay, so this is the link that I've already sent you, right? So once you sign up and you get your name, everyone has done this part.
Yes, sir. No, sir.
Okay, guys. Now, one sec. Have we got one login from one creation of ID? I'm not talking about logins at this stage. I'm talking only about the creation of ID and password. Has it been done for every team? Yeah. This link which I sent you, has it been done for every team? Who has not done it? Your team has not done it. Gaba has not done it. You are also not done it. Okay, so please make sure you do it, guys. Please make sure you do this quickly because I want to make sure that our backup our backup software is ready and running, okay? And while we wait for the TWS to get ready. So please make sure you do it tonight, okay? Is there anybody with a problem who doesn't have an overseas phone number?
So one thing I have to tell, sir.
That problem doesn't exist, right? Yes.
So we don't require an overseas phone number. We can just give an incorrect number to.
I don't know.
Sir, it was not asking for any OTP or
No,
nothing.
it might, no, it's not a question of OTP, they might call you, okay, one sec. And the number that you give, please make sure if your sister in London or something, if she gets a call from these guys, they will just call just because they want to market their product, okay? And they won't harass you as such, okay? But they may just call just to verify once. So just tell her that, you know, she should not say that I don't know where you got this number and all that. Are you following what I'm saying? Okay. So, so please make sure you get this sign up done, okay? And hopefully tomorrow, by tomorrow's class, we'll have everybody signed up. So I'm just going to show you what you have to do. I want to make sure that the backup software is running
Sir, it's
smoothly.
We have to create three logins.
No, you just create one login. If you want, I'm only asking for one login. I need at least one login per team, that's all. If you want, you can create one more, that's your problem.
So that will be the practice session.
I'll explain all that, don't worry, just follow instructions at this stage. Okay, so now what you have to do is, okay guys, now please be quiet here. Please understand what's going on here, okay? So you go this, you can see all this on the video, on the screen capture. So you go here and then you go to trading, look at platforms, then you try to look at the desktop trading platform. Okay, I'm assuming that you can also open your, you can do your own stuff on your mobile phones. They have a mobile app also, but that's separate. I want you to do the project on your laptops. Okay, so I'm going to show you only the desktop based. This is not the features actually. I want to see the download link. Okay, CFD Forex desktop trading platform. Where is the download link? EC2A.
So get a desktop back.
1 minute. Download the desktop. So you will download the practice platform. Okay. Okay. So if we do this download practice, so you see that something is downloading. Can you see that? Yeah, you can see the download that's happening. Oanda desktop, MSI. Okay, so there will be a download. If you click on this, you'll get the download. Then you run that. Okay, you run that, and then let me just show you. So this download is happening. Okay, so you'll get this download, then you run it. Okay, then you run it, and what you should end up getting is something like this. Please pay attention to what is being discussed, okay? I want to make sure that everybody is ready and running by tomorrow morning. Okay, so you will get an icon like this on your desktop. Is this clear? Okay, now then you click this. Okay, now for this platform, please check on the website, navigate to the troubleshooting, the technical help. You need to have Java running on your laptop. Java, latest version of Java should be updated. If there's any other problem, do the troubleshooting on there. They test through some of the ports and all that. Okay, if the ports are open, they will run some tests. Please do the troubleshooting on your own. Okay, you guys can find that help section on your own, technical help, and do the troubleshooting and make sure that it.
So from a single login, we can have multiple apps.
1 minute. I'm just coming to that. I don't know why this is not opening. I'll explain all that later on.
The download is still not completed, I guess.
Yeah.
Sorry?
Download is not completed.
No, in my case, I'm just showing that I'm just doing that to show you guys what to do. My download is already there because I've already got it on my desktop. Okay, so.
Sir uses Oanda desktop live.
So Java, when you're downloading Java, guys, Java is what you're downloading is Java Runtime Environment, JRE. Is everyone clear about that? You do not need the JDK. The JDK is the Java Developer Kit. Okay, that you don't need. You need only the JRE. Okay. So once again, guys, please pay attention. There's too much noise in the class. So once you do that, you get a desktop icon. You click on it, you get this kind of pop-up. This is where you enter your username and password. Okay, and then you enter your username, password. You will have I can just test here. This you'll see. This is the so you enter your username and password. Obviously, you have to be connected to the internet. That goes without saying. And then I'll show you what to do in terms of account setup. Maybe what we can do is we can do that part.
In next
Then I'll show you now because we still have a little bit of time.
So, but those TWS software and logging correctly, we can do in that also by to use.
1 minute. This is just a backup, as I said. If we can make the TWS work, we will work in TWS. But this is our backup. I need to have a backup ready because I need to make sure that the project can be done. Otherwise, see who's this fellow who went out, didn't close the door properly. Why is it taking so long to log in? Okay, so it will log in eventually. Okay, and you'll get this kind of data. All right. So what you should try and do is, I'll just close this for a while. Okay, you'll get this kind of data. What you have to try and do is just shut the door here, Akshit or Chanda, just shut the door, slam the door shut because this who went out. Sina, when you guys go out, shut the door properly. I don't know why we have to have a course for you guys to shut the door. Even your junior batch, when they come into that room, they don't shut the door properly. When you shut a door, means you slam it shut, fully shut.
So we can create a tutorial.
Okay, 1 minute, 1 minute. This is what you have to do. This is part of your tutorial. 1 second. Okay. So you have to create a sub account. Okay. So when you get into the account, you can see here. This is the name, the username, primary. You will always be logged in initially to primary. Okay. This is my account number, and this is in US dollars. Okay. The primary account is in US dollars, and then what you have to do is you can go there. You should create at least 2 accounts. Okay. You can create or you can practice in your primary, and then you should practice creating a sub account. Okay. When you click on create sub account, let's see what happens. This might actually open my Firefox because so on this platform you can see this is a very good platform actually. Of course, you're in India, you're not allowed to trade in foreign exchange. But if you want to trade in foreign exchange, actually this platform is better than TWS. Okay, so but in India you're not allowed to trade in foreign exchange. If you have a relative who is willing to fund an account created abroad in a different jurisdiction and give you the ID and password to trade, but then again that's still not advisable because they've not allowed you to trade. So you should not trade in foreign exchange. But that actually the requirement applies only to money sent from outside India, from India to outside jurisdictions. But strictly speaking, if you open your sister's open an account in London and she's given you authority to trade, there's no problem as such. Okay, on the face of it there might be a problem, but anyway. Okay, so we got this opening here, secure sign in. Why is it asking me to sign in again? Because
you open the new account, download it again.
no, it's
Created server. That is
okay. So you have all these sub accounts, FX Trade Practice accounts. These are all previous accounts. Okay, so what you have to do is, my friends, there should be an opportunity here. They have to reach. They have here. Add new sub account. Not responding for some reason.
So I think the limit has been crossed.
So I don't think the limit has been crossed. Okay, I'll just figure out what the problem is here, but this is where you try to go and create.
actually in India we can trade equity
So now you can trade.
in this software.
No, you can't trade equities on this software. You can't trade Indian equities on this software. Okay, guys, so I'll let you go now. I think one sec. Okay, I'll let you go now for today, and then make sure that everybody tomorrow morning when we come in, we should have everybody with one vendor practice trading accounts at least ready.
Yes.
And then I'll show you how to set up the sub accounts.
You have to bring a laptop.
No, you don't have to bring your laptops. No, this one doesn't have Java on it. So you don't have to bring it. You just have to make sure that you have the job done. You should have your ID and password. Right? Yeah.
Your primary account is for practice and sub account is for main trading.
Yes.
And we have to mainly trade in futures and options.
No, that I'll show you what you want to trade. So remember, this is our backup option. This is not our main option. I'm just setting up some backup software and so that in case the TWS nets is down, we can use this.
In interactive broker, we also have to trade in futures and options now.
Not options, but futures.
So action on 11th and 12th September. 11th is for Ratan that you are not interested for that day, and on 12th for Samkara.
Samkara, I got a
For
mail.
last Lalita ma'am to send the mail, but for 11th we are not.